Good morning. Welcome to Tower Property Fund's 2020 results presentation for the year ended 31st of May 2020. My name is Mark Edwards. I'm the CEO of the company, and I'm joined by Joanne Mabin, our CFO, who will take us through the financial part of the presentation. Just some format for today. This is our first online presentation, and obviously due to circumstances, it's been required. There is a little box that you can click on where you can ask questions to the left-hand side of your screen that you see. If you do have any questions during the presentation, please do send them and we'll answer them at the end of the presentation. We are, as per normal, seeing our big shareholders in one-on-one meetings this afternoon and Monday and Tuesday. So we look forward to chatting to you guys then. And then as we always do, if you have any questions that you would like asked separately and you want to get in touch with us, you are welcome to come to our offices in Claremont, or you're welcome to phone or email. The presentation will be followed. You can follow the presentation online directly. It also has, for your benefit, been put onto our website, as well as the SENS announcement of this morning and the more detailed leaflet you'll find on our website. So Tower strategy, for those investors who are new, is to add value through local and international property asset management. We have a portfolio in Croatia, which now accounts for 37% of our value, and in South Africa, represented in Cape Town, Johannesburg and Durban. It's a mixed-use portfolio of office, retail and industrial properties, with some residential that's recently crept in after we developed it at Cape Quarter. We plan on growing returns through reinvesting capital in our own portfolio currently, certainly not trying to raise new capital for acquisitions. The most important thing is that bottom highlighted bit where we say that the COVID-19 has obviously been a complete game changer for the world and certainly the property industry in South Africa. And our extreme focus since the 26th of March has been the retention and the survival of our tenants, particularly those most vulnerable, the highly impacted tenants, including restaurants, coffee shops, hairdressers, etc., and we'll take you through our COVID-19 initiatives. Just some financial highlights for the year. Our loan to value increased to 39%. Our portfolio vacancy increased as well to 7.9% overall. Our average collections for the period April, May, June and July during COVID were 85%. We did sell 620 million rands worth of properties in the last 12 months, the most recent being the sale of the 9.1 million euro Velika Gorica property in Croatia. So we've sold 22 million euros worth of Croatian properties and 190 million rands worth of South African properties, which we'll talk to you later. The two big items that we covered in this past financial year, the two big decisions. The first is the decision to reduce the distribution to 75% of our distributable income. This was important for us because the future is very uncertain, and the decision to retain as much capital as possible to navigate these tricky times was made by the board. Certainly our ability to navigate these times was aided by the strength of our balance sheet going into this crisis. We did pay off some euro-denominated debt during the past 12 months and refinance some debt, which certainly aided in us having adequate cash resources to go into COVID-19 and the resultant lockdowns. The other big decision, and something that we've been contemplating for a long time, was the refinancing of some of our euro debt. In fact, most of it. There's only 9 million euros still to go. So 31.5 million euros was refinanced with Standard Bank, and we swapped the euro denominated debt to rand denominated debt because we had rand denominated assets securing that debt. The reason why we chose to do this was because of the threat to loan to value that we had, and as we've previously explained to a lot of shareholders, the threat to currency blowouts existed in our previous structure, whereas now we've managed to eliminate that risk completely. It does come with an increased interest cost per annum, but certainly it's much better for the long-term sustainability of the business. In terms of operational highlights, I've mentioned our vacancies. We've got a lease expiry profile of 3.5 years in the portfolio. We had 1.7% positive rental reversions, which was mainly driven by the industrial portfolio, with retail and offices going backwards. Tenant retention of 74%, so that was the amount of tenants coming up for renewal that actually renewed. There's a bit of anomalies in there. In Upper Grayson Drive, one of our big tenants, Mimecast, of 2,000 square metres, went and built their own building. So there's reasons for that lower tenant retention. Our net operating costs reduced to 17%, with gross recoveries of 32%. Our portfolio value is just under 5 billion, with 260,000 square metres of rentable area. I've mentioned the occupancy rate and the gearing. We have average rental of 127 Rand across the portfolio. Our existing lease escalations have definitely reduced over time to 7.5%. I think gone are the days where one can just automatically assume an 8 to 9% lease escalation. We're finding a number of our national tenants now pushing back to CPI-linked inflations. Our average property size is 114 million. I'll now just hand over to Joe, who will take you through the distribution analysis. We're just going to switch seats quickly, so just bear with us for 5 seconds.
Good morning, everyone. Starting with the distribution analysis, our net property income is down 3% compared to the prior year. On a like-for-like basis, the net property income is down 3.2% in South Africa and 1.9% in Croatia. This is mainly as a result of COVID relief granted. If it hadn't been for COVID, we would have been flat for the year. Taxation includes 7.5 million tax, which arose as a result of the decision to reduce the payout ratio to 75% for the year. The balance relates to tax leakage in Croatia and Mauritius, which is marginally down on the prior year. Non-controlling interests include the Oryx 26% holding in TPF International, our Mauritian subsidiary, and the VMD Group at 20% holding in Tower Europe. Our distributable earnings is 15% down for the year. This is as a result of the decrease in the property net income, our increased finance costs to fund capex, debt cancellation fees, and the sale of assets at yields higher than the cost of debt. Development income lost relates to untenanted properties under development during the year. Previously, this has mostly related to the Cape Quarter Square and the Old Cape Quarter development. Tower is no longer going to distribute this development income lost. Tower has reduced its payout ratio, as Mark mentioned, to 75% of distributable income. In the prior year, it was 107%. It was more than 100% because we distributed the development income lost. Our distribution per share is 44.5 cents for the year, 40% down on the prior year, and a final dividend per share of 9.5 cents will be paid. Moving on to the statement of financial position. Balance sheet strength and liquidity has been a key focus for the fund during the past year. Our investment property is down as a result of the reduction in the asset valuations and sales. Our South African properties make up 63% of our portfolio by value and Croatian 37%. Goodwill arose on the acquisition of Sub Dubrovnik and the internalization of the asset management company, Tower Asset Managers. All goodwill has been impaired during the year. Inventory includes the Napier Street residential units and the Old Cape Quarter residential units under construction. Our trade and other receivables has increased because of prepayments made in respect of the Old Cape Quarter development, as well as an increase in trade debtors as a result of COVID. Cash increased due to excess funds being moved from access facilities to call account during lockdown, and the proceeds from the sale of Vukovarska received into TPF International. The proceeds from the sale were used to settle South African euro debt post-year end, and all excess funds were transferred back into access facilities. Investment property held for sale relates to Velika Gorica, a Croatian asset of ours, which transferred on the 30th of July. The bank debt I'll cover in the slides to follow. The rental guarantee liability relates to 24 million that Oryx paid Tower to guarantee the difference in the contracted rental and the rental received from Agricor for a 2-year period. In respect of the first year, Tower had to reimburse Oryx 300,000 rand, and for the second year, Tower owes Oryx 1.2 million rand, which was settled post-year end. The remaining 22 million was released as a fair value gain through profit and loss. The net asset value per share is 7.62 rand. This is down because of the fair value adjustments to investment property, a lot of which was a Cape Quarter precinct, as well as the interest rate derivatives and the impairment of the goodwill. Our tangible net asset value is now the same as our net asset value as the goodwill has been written off. Looking at the capital structure, we have broken the debt down into our rand and our euro debt. The euro debt comprises Croatian in-country debt, as well as euro debt held with Standard Bank in South Africa. The weighted cost of funding is 4.9% for the year. Our debt expiry profile is 2.5 years. Our percentage hedged is up to 87%, and our hedging expiry profile is 2.2 years. During the year, we have successfully refinanced all our Croatian loans from amortizing to interest only, achieving interest rate savings of from 1% to 1.65%. We refinanced 159 million rands worth of debt for 3 years and extended the 500 million rand swap at a saving. We have used the full proceeds from the Vukovarska sale to reduce debt, including 6.5 million euros of Tower's SA Euro debt. We refinanced 31.5 million euros worth of debt with rand debt from Standard Bank at an all-in interest rate of 7.02%. This refinance took place at exchange rate of 19.06 rand to the euro. Tower used its attributable portion of the Velika Gorica sale, net proceeds amounting to 3.6 million euros, to reduce the SA debt further. So the SA Euro debt is therefore reduced from 47 million euros at year end to 5.4 million euros. We feel that this has significantly de-risked our balance sheet. This slide breaks down our debt by country. Our loan to value has increased to 39.1%, with our SA loan to value increasing to 45.6% and Croatian to 28.2%. The pie charts highlight the SA Euro debt, reducing from 41% of the total debt at year end to 9% post the Euro debt refinancing. At year end, and previously we had a natural NAV hedge where Tower's investment in TPF International was similar to the South African Euro debt. Post year end, this Euro debt has now reduced. Previously, we also had a natural income hedge where our euro rental matched our euro interest expense. Post the refinance of the euro debt, the interest expense has now reduced, and we are in the process of hedging all net euro inflows. Thank you. I'll now hand back to Mark to take you through the operational performance.
Thanks, Joe. From an operational perspective, we let 43,500 square meters of space during the period, with 24,000 of that being new leases and 19,000 being renewals, talking to that 74% renewal percentage that I meant, or retention percentage I mentioned earlier. We have vacancies of 20,500 square meters. Total vacant space in Croatia has actually come down substantially from 4% last year to 1.7% this year, but we don't actually suffer any ill effects of those vacancies because we do have head leases in place. From a top 10 properties by value, all of our Croatian properties are now in our top 10 properties by value measured in rands. As Joe mentioned, Cape Quarter has come down in value. It's still our biggest asset, and we'll talk to those valuations shortly. So the major valuation movements, it was very difficult this year to do directors' valuations. So what we did was we outsourced our valuations to our independent valuer on almost all of our portfolio. 97% of our portfolio was independently valued. Certainly cap rates came down ever so slightly, but where the major valuation movements are, and this has been sectorally discussed, was in the rentals coming down. Ours was limited to a few properties which are highlighted in the slide. So our valuations in South Africa decreased by 10%, which is in line with what the sector kind of felt between 0 and 20. That was linked to Upper Grayston Drive, which is a Sandton A-grade office space, and the vacancies in Sandton, as everybody knows, are very, very high. Cape Quarter Square was the biggest reduction in terms of rand value of around 260 million. Cape Quarters is mainly linked to the Deloitte and Pernod Ricard vacancies, which are coming up. Pernod Ricard is currently vacant, and we're looking to put shared workspace in there. That should be online shortly. On the Deloitte space, we have a lot of interest in that space, but the rentals have reduced dramatically. We've told shareholders before that Deloitte were paying 330 Rand a square metre on expiry. That's come all the way down to 150 Rand a square metre as to what the market rental is for that space in that node at the moment. We have, from a budgeting perspective, we have eliminated as much as we possibly can in terms of assumptions. We've been ultra conservative in our projected net income going forward. However, one never knows what's going to happen in the market. We do think that there is potential upside in certain properties, but Cape Quarter is the one that we're focusing our most attention on at the moment, and I'll discuss the development too. From an impact of COVID-19, it's obviously been a tremendous impact on the business, although we have been quite sheltered. We've given 6 odd million rands worth of rental concessions and around 5.5 million rands worth of rental deferments. The concessions are typically given to those tenants who are most highly impacted. That would typically be 100% off for April, 100% off for May, and then working on a sliding scale from June onwards. Now the difficulty is particularly on the retail tenant side, is when tenants are opening up, seeing what we need to do to help them. A lot of tenants are asking for turnover-only rental, which is obviously difficult for a REIT to give because it's difficult to value, and we need to keep our shareholders satisfied and our bankers satisfied. But that's been a process that we're walking through with each individual tenant. We formed a credit committee to assess all of these valuations, and there's been a significant amount, obviously, of requests. Some we've granted, some we've pushed back on. The office sector has been the one which has been obviously the most resilient because a lot of the tenants could work from home during the period. So if you look at the sliding scale in April, May, June and July, our total billings went down per month, mainly as a result of electricity recoveries because of a lack of occupancy on the properties during lockdown and a lack of use of electricity. And then there were 1 or 2 tenants who expired. We've got a building called Wellington Road in Gauteng, and the major tenant there didn't renew their lease, hence the resultant reduced billing. Our collections are as we expected. We didn't expect, in fact, April to be that high. We always thought May would be the most difficult month, and you can see the gradual increase in collections up to 89% for July. From a sales perspective, I mentioned the 620 million rand. So in South Africa, there was 189 million rand. We've covered this before. Meadowbrook Distribution Centre sold last year for 91.6 million rand. The valuation at the date of signature was 85 million. And then the MedScheme office building in Florida North, Gauteng, for 103 million. The valuation was 103 million. The selling price 97.5, at a yield of just under 10%. It was a strategic sale, this one, because it is in an area that's decaying. From a Croatian perspective, we sold 2 non-core properties, Vukovarska and Velika Gorica. These are standalone hypermarket type properties where the supermarket anchor Consume occupies most of the space. And then, like a typical Checkers or Pick n Pay hypermarket, we've got 8 or 9 line shop tenants, a lot of them owned by the Consume store. We got excellent offers on the Vukovarska property of 12.4 million euros against a valuation of 11.1, and that deal was done. And the Velika Gorica property was sold to the same consortium, or a similar consortium, similar shareholders who we know well over there, and they paid full book value for that property at a selling yield of 7.5%. TPF International has done very well for us. It's been a really defensive hedge for us. Certainly their lockdown was a lot shorter than South Africa's, and wasn't ever as stringent. Retail sales grew in March, as was experienced in South Africa, as people did bulk buying before the lockdown, and then naturally subsided in April and May. We gave 50% rental concessions to the Lion shops, not to the main supermarket anchor, in Croatia, and we gave 15% reductions for April and May to our VMD office tenants in Croatia. Our portfolio size of 91.6 million, and our loan to value is low there at 28%. We have 0 vacancies, as I mentioned earlier, with the head lease. Our intention is to grow our exposure to that region. We are seeing a number of very, very good opportunities. Naturally, we just need to find the cash within the existing portfolio. So from a deployment of capital perspective, Cape Quarter is our hungriest recipient of cash. We've spent 112 million rand in the past 12 months on Old Cape Quarter, the development. If any of you are in the area, we suggest that you go and have a look at the development. We would love to take you guys around. In fact, we'll organise a shareholder tour of that towards the end of the year or early next year as it takes shape. We are experiencing a significant amount of interest now on the commercial space. 15 million rand was spent on Modi Moli, a convenience shopping centre in a lower LSM market where we replaced ShopRite with Pick n Pay. Pick n Pay are exceeding their turnover expectations, which has been pleasing to see. We did a facade and painting upgrade at Link Hill Shopping Centre, which is a centre that we need to put a lot of work into. And we're expecting another 40 or 50 odd million rands worth of capex to be spent at Cape Quarter moving forward. We're pleased to announce that we've secured Clicks as a retailer for Cape Quarter on the restaurant level, and we're also pleased to announce that we've secured Checkers for Old Cape Quarter, subject to our board approval still, as an anchor for the development. From moving on to continuing on the developments, construction for Cape Quarter is expected in Q3 of 2021, with the residential apartments completing at the time. The occupancy for commercial will be available towards the end of this year, but it's just troubling to have occupancy when the main crane is still up for the residential apartments. Residential sales have all but stalled. We've appointed additional agents. We've reduced selling prices to try and encourage acquisitions. Foreign buyers are taking a wait-and-see approach. We do have a number of interested parties in discussion with us at the moment, but sales in this market is naturally very difficult. Our plan B is to short and long-term let these assets, as we are doing for the 21 apartments we currently own at Cape Quarter, and the take-up of those apartments was faster than expected and is pleasing to see, with them being 100% let. As I mentioned, there's significant interest in the commercial space at Old Cape Quarter development, and we expect to have that let certainly well in time for the development. From a risks perspective, the biggest risks in the fund are undoubtedly Cape Quarter at this point in time, with the expiry of Deloitte's and the vacancy of Pernod Ricard. The vacancy of Pernod Ricard presents a very exciting opportunity to pursue shared workspace. We've already secured our first tenant for the shared workspace premises, and from a Deloitte's perspective, we do have quite a significant amount of interest in normal traditional offices. We've also got hotel interest, wanting to take the entire Deloitte's premises as a hotel. The difficulty with hotels naturally is the amount of capex that they require, which is significant. So we're working through those different choices to make sure that we come out with the best solution, which will probably be offices for that space, and we are looking to sign deals in the next few weeks. From a DeVille perspective, the biggest risk is Virgin Active. Virgin Active has now been able to go back to work. Our renewal with them is the end of the year. That renewal was obviously compromised as a result of COVID-19. They have given us the indication that they do intend renewing. Naturally, the rentals that we currently charge and that we will be charging will come off ever so slightly, but not as badly impacted as we once feared. Link Hill Shopping Centre, the repurposing there, we've definitely got our work cut out for us in rebranding that centre and making it a bargain type of centre, so that Bruce Rogerson, our asset manager, and myself are working hard on that with the management team. And then from COVID-19 perspective, it's been a very difficult period, considering cash flow, etc. Our cash flow has been very strong, but predicting future cash flows with this uncertain market has naturally been difficult, which I think all the funds are struggling with. We're definitely seeing it getting better, and getting better by the day in terms of recoveries, but one has to be cautious as to what's around the corner. Our corporate social responsibility remains Ubuntu, and we're pleased with their progress. Certainly they were affected by COVID. They had to close down the residence and send those kids home. Some of them live in terrible situations where the home life was considerably worse than the school life. They managed to get some of those boys back under lockdown to the residents, and the school is doing well. The football program has all but been placed on hold because of COVID-19 and lack of professional sports competitions, but they're back into that now. So it's actually been quite a blessing to focus on the education side of things this year for them, and they've done particularly well. Naturally they're always keen on additional funding, and if anyone wants to assist in funding them, some of our big shareholders have taken up that challenge, and we're very grateful to them for that. But if you would like to contact me on that, you can. So our value add opportunities, Napier Street is now complete. We own six apartments in that building, and there's still some snags that we're dealing with. Unfortunately, the builder liquidated their business, which makes obviously dealing with snags a little bit more difficult, but it is quite typical these days in this market. So we're dealing with one or two very minor snags at almost no cost. Old Cape Quarter, I've mentioned, is in progress and is the biggest initiative of the fund and taking our most attention. The reduction in Standard Bank euros, Joe mentioned there's 5.5 million now left. We intend financing a property over in Croatia called Meridian Shopping Centre, which previously has had no debt on it. We intend taking out euro debt and bringing that back home to reduce the Standard Bank debt. So we'll eliminate in the next few months. We'll eliminate the Standard Bank debt, and strong focus will be on our convenience retail. We really believe that we need to increase our exposure to convenience retail and reduce it to other asset classes. That's been the best performing asset class for us, and certainly is the most offensive, and something that we're going to aggressively look to grow going forward, particularly in Croatia. Joe and I have mentioned the distribution of 75%. We don't expect Tower to increase our distribution to 100% again in the future. We expect it to be around the 90% mark. Certainly the interim dividend payable in March of next year is going to be one that we're going to have to consider very carefully based on forward cash flows and see how the next few months pan out with COVID, if the recoveries continue to increase as they are. A great deal of focus on Old Cape Quarter development, and we'll look to aggressively sell SA properties. We've said this before, but what we're doing at the moment is we're actually selling very small sections of our portfolio in Johannesburg. So we recently have concluded a deal at Upper Grayson Drive for a very small section at a 20% premium to book value, and we think that that's the way to aggressively sell our non-core assets, and we will be doing that going forward, given the amount of stock on the market. So that's our presentation. Thank you so much for listening. We know that you're all going to just log on to the NEPI presentation now, but let's just check if we've got any questions quickly. Nothing's been asked of yet. We'll see our major shareholders starting this afternoon. Thank you very much for your time.